If you don't like tracking the Fed, but still want to understand your finances, this is for you. Understanding how the Federal Reserve's decisions impact your daily life can be crucial, even if you find financial news a bit dry or overwhelming. On September 18, 2024, the Federal Reserve cut interest rates by 50 basis points. This decision was made after careful consideration of various economic indicators and trends. But what does that mean for you? How does a change in interest rates by the Federal Reserve trickle down to affect your personal finances and the broader economy? First, let's break it down. Understanding the basics can help demystify these financial moves. The Federal Reserve, or the Fed, is like the nation's financial referee. It oversees the monetary policy of the United States, aiming to maintain economic stability and growth. It sets the rules for money flow to keep our economy stable. Basis points? Just a fancy term for 1/100th of a percent. This small unit of measure is crucial in the world of finance. So, 50 basis points equals 0.5%. While this might seem like a minor adjustment, it can have significant ripple effects across the economy. Why the cut? Our economy's been slowing down and inflation's a concern. The Fed uses interest rate adjustments as a tool to either stimulate the economy or cool it down. When the economy shows signs of slowing, the Fed might lower rates to encourage borrowing and spending. Conversely, if inflation is rising too quickly, the Fed might raise rates to make borrowing more expensive and slow down spending. So the Fed stepped in. By cutting rates, the Fed aims to make borrowing cheaper, which can help stimulate economic activity. Now, the federal funds rate is lower by 0.5%. This rate influences other interest rates in the economy, including those for loans and savings. What does this mean for you? Borrowing costs could drop. This is particularly relevant if you have or are considering taking out loans. Think lower rates on credit cards, mortgages, and auto loans. If you have existing debt, this could mean lower monthly payments or the opportunity to refinance at a better rate. But savings accounts and CDs, they might not earn as much. Lower interest rates can mean lower returns on savings, which is something to consider if you rely on interest income. They might not earn as much. This can be disappointing for savers, but it's a trade-off for the potential economic benefits of lower borrowing costs. Stocks could get a boost, especially dividend stocks, as lower interest rates can make equities more attractive compared to bonds, while the dollar might weaken a bit. A weaker dollar can make US exports more competitive abroad, but can also increase the cost of imports. And in the long run, this move might nudge inflation up slightly, but aims to stimulate growth. The goal is to create a more robust economic environment. This move might nudge inflation up slightly, but aims to stimulate growth. More hiring, cheaper business loans, and maybe a more active housing market. More hiring, cheaper business loans, and maybe a more active housing market. These are some of the potential benefits of a rate cut. So, what should you do? Borrowers, consider refinancing. Lower rates can provide an opportunity to reduce your interest costs. Savers and investors, reassess those fixed income strategies. With lower returns on savings, you might need to explore other investment options. Business owners, it might be time to expand. Cheaper loans can make it more affordable to invest in growth. Stay updated on future Fed moves. The Fed's decisions can have wide-ranging impacts, so staying informed is key. Subscribe for more economic updates and smart financial advice. Keeping up with financial news can help you make better decisions. Catch you next time. Stay tuned for more insights on how economic changes can affect your finances.